You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have British American Tobacco, B&M, SSE, Hollywood Bowl, Pets at Home, and our US company of the week is PayPal. Sam, shall I kick us off with British American Tobacco?
Yes, how are they doing?
So they had a trading update and much the same. So basically, they've said they've taken a robust approach to their pricing in their combustible products in the first half, which saw market share decline by 0.2 percentage points in its key territories. And across the industry, cigarette volumes are now expected to drop by about 2.5% this year, which is up from the 2% decline previously expected. New categories sales growth expectations have actually been upgraded from low double digits to the mid-teens. However, the group guidance for full-year growth remains at the low end of the medium-range targets. And those are around 3 to 5% for revenue and between 4 and 6% for underlying operating profit. British American remains on track to reduce debt levels to around 2 to 2.5 times underlying cash profit EBITDA by the end of the year. And the shares were down about 3.3% in early trading. In terms of valuation, that has a market cap of £93 billion and trades at 12.3 times forward earnings, compared with a 10-year average of 10.3 and a prospective dividend yield of 5.5%. I don't think there were many surprises here. This is largely what we've come to expect. Market share, 0.2 percentage points down, very small. And in terms of the next generation or new category products, as they call them, decent upgrade, but nothing really shifting things majorly there. It does sound like there has been some encouraging noises from their point of view in terms of a US regulatory environment, particularly when it comes to new categories. But otherwise, nothing majorly, I don't think, has changed here. I think probably, and I've said it before when we've been looking at British American and Imperial brands, there does seem to have been somewhat of a re-rating, although not to the to the level of the US peers in terms of the multiples that they're trading at. 12.3 times earnings, and we've seen the 10-year average of 10.3, but it has been significantly lower than that. And the dividend yield, again, it's by what it compared with what it has been at points over the last 10 years, a more modest 5.5%. So again, it's a stock that I'm sure a lot of income investors will be looking at, particularly if they're comparing it with the US peers. It's a fair bit cheaper than your Philip Morris Altria groups. I don't think probably at this valuation it's going to get many people too excited. Obviously, there are the ethical concerns with it, but even on a valuation basis, in terms of other things, I guess volume decline, it's fairly modest. Again, by what we've come to expect. There were stages over the last 5 years where we've seen it in higher single digits in terms of combustible decline. So again, that, whether it's 2 or 2.5%, it's still fairly modest by some of the standards that we've got used to. Sam, would you have anything further to add?
Not really. I would echo that. I think a 2.5% decline is pretty good in terms of the volumes. I think you'd take that all day long if you're British American Tobacco. But yeah, I think it's a good set of results. But yeah, I just wouldn't want to pay 12 times earnings for it when you look at where it's been historically. So yeah, pretty similar to when we covered Imperial brands a few weeks ago.
Do you think it would change if you were a US investor?
It's cheaper by comparison, I guess. So possibly, because I think it is a quality business. It's difficult because I know what it has been at for so long. I do just struggle. I'm anchored.
And it is interesting as well. Kenneth Dart of Dart Group, who, well, I was going to say he's one of the world's richest men. He's a billionaire. He did take quite big stakes in both British American and Imperial. Again, kind of over the last 5 years, where we saw it in kind of higher single-digit territory. So when they were really, really cheap. and he has now taken profits and sold out, which is quite, I think, interesting too.
Should we move on to a business where I don't think anyone's taken any profits recently?
Okay. B&M. Any more accounting errors, Sam?
Not that we're aware of, but
Okay.
it does remain a genuine risk, as I'm going to get onto later. But B&M, the discount retailer, have come out with their full year results, and revenue was up 3.6%. Operating profit was down 33.8%. Profit before tax was down 47.3%. Diluted earnings per share was down 48.8%. Cash generated from operations was up 2.2%. And the adjusted figures weren't down quite as badly, but they're pretty horrendous too. Net debt actually improved by 15% to 656 million, and the dividend has been cut by 36%. They've highlighted that there was total value and volume growth in both B&M businesses, and this was partially offset by a 0.3% revenue decline at Heron Foods. Their total UK sales had growth of 2.9%, and like-for-like sales were broadly flat at negative 0.1%. B&M France saw total sales growth of 13.4%, driven by 2.9% like-for-like and higher transaction volumes and 12 new store openings. B&M France gained market share, finishing the year with 8.4% of the discount market compared to 8.1% a year ago. They had 64 gross new stores opened across the group, and that was 33 net new openings, with 41 in B&M UK, 22 net, 12 in B&M France, and 1 net closure in Heron. Post-tax free cash flow of 321 million, which was up slightly. They've said that reflects working capital inflows as inventory reduced through accelerated clearance activity and range refocus, in line with their Back to B&M Basics plan. Net debt to adjusted EBITDA ratio was 1.4x, and that was up slightly from 1.3x. They're expecting a slower start to the garden season in B&M UK compared with last year, when unusually early warm weather drove double-digit like-for-like sales in April 25. Better weather in late May this year has driven a recovery in sales of seasonal categories. And B&M France has made a good start to the current year, with higher footfall and market share driving positive like-for-likes. Heron like-for-like sales have made a positive start to the year, and they continue to make improvements on in-store merchandising and ranging to bring about a broad recovery in Heron's sales performance. In terms of the valuation, the business trades at a PE of 9.65 and has a yield of 5.13%. As we alluded to earlier, they have had some scandals recently. So in the past 12 months, they had an internal accounting scandal that resulted in the CFO leaving, a £14 million High Court lawsuit from a supplier, and being named by the government for failing to pay the national minimum wage. The accounting scandal was probably the most publicised because it just got worse and worse, which is partly what's led to that inventory reduction. So that's why it, I think, is so cheap when you look at sort of the numbers they're putting up, the French operations. Historically, they've been quite a good operator. It was a business at one point, I think it's fair to say, we quite liked, but I think it's pretty cheap. But once you've had those scandals, I just think it takes a long time before you can trust those numbers again. So someone might come in and do very well at it. I think when you look at the share price, so for context, it's down 30% in the past 12 months, 60% in the past 5 years. And it's not that far off the lows. So the low for the year, it looks like it was about £1.50, and it's at £1.85 now. But considering it was over £5 at one point, I think that tells you how much faith people have in it at the moment. But I uninvestable because I just don't think you can trust the numbers, and I think it'll be a long time before that changes. What about you, John?
Yeah, no, similarly. The other thing that I would probably add to it is I do wonder how much the big supermarkets, so Tesco being the key example to this, price matching and competing with discount retailers. I know that the offer from B&M is a bit wider than just groceries, but I do wonder how much that is hitting B&M. And also with the scale of Tesco's, with a market cap of, 10 times, maybe more, how much they can compete on price with that, particularly as Tesco had that turnaround and really went hard on price. That would be another concern of mine.
I think it's difficult to answer that because I think obviously Aldi and Lidl I don't think they're even listed anyway, but we don't cover them. So you don't have that data really from kind of a pure sort of grocery discounter. I guess on the flip side, Asda and Morrison's, they're both doing atrociously. And whilst Tesco and Sainsbury's are doing quite well, you'd think kind of everyone's probably taking, especially Asda, you'd think they're kind of where their customers are more likely to be going to the discounters. But that's with the caveat we don't know.
Okay. So on to SSE then. I think it's been quite a while since we covered them, but they had the full year results out with full year revenue rising by 1% to £10.2 billion. Expanded renewable capacity and inflation-linked tariff increases in transmission was largely offset by declines in other business units. Underlying operating profit fell by 8% to £2.2 billion, driven by large expected decline in distribution profitability, as last year's performance benefited from a periodic inflationary adjustment. Free cash outflows widened from around 200 million to around 700 million, driven by increased levels of infrastructure investment, and underlying net debt remained broadly flat at £10.1 billion, helped by a £2 billion equity raise in November last year. In the year ahead, investment spending is expected to increase from 3.6 to over £5 billion. Underlying earnings per share is expected to land between 168 and 193 pence. A final dividend of 47.3 pence per share was announced, taking the full year total to 68.7 pence, which is up 7%. The shares were broadly flat on the results. In terms of valuation, SSE has a market cap of £28 billion and trades at 13 times forward earnings, which is broadly in line with the 10-year average, and it has a prospective dividend yield of 3.1%, which is below the 10-year average of 5.4%. I thought these results okay. It's an incredibly difficult sector, heavy government interference. It's also very capital intensive. So all the things you don't want, really. And I think if you were an income investor, going back to those 15 years post 2008, ultra low interest rates, and seemingly a relatively benign political landscape, I think you could have seen the utility companies as a kind of a bond proxy. You'd be getting a safe and relatively decent return. I think that's all changed. It's political interference to the max now. There's also the debate whether we're going or heavily going down the net zero route or whether a future government might turn that on its head. It's very difficult to plan for the long term, particularly with that kind of level of instability. I think the other things that have changed as well is that interest rates are now much higher. So you can essentially have a risk-free return. If you had a short-dated gilt, a year or two, about 4%, maybe a bit higher. And if you were the sort of investor who might be paying tax on that, well, a gilt, certainly if it was in the form of a capital gain, then the actual or the gross equivalent yield would be significantly higher. So again, that makes these sorts of companies a lot less appealing. And we may be having Andy Burnham, who knows. He has been quite scathing of former state industries that have been sold off. So, even more reason that you would probably want to stay away. And also, if you do look at the income that you're getting, it's not that high anymore. So on many levels, I would be staying well clear. The other thing to add, it's not diversified in the sense of it being essentially 80% exposure to the UK and then about 20% to the Republic of Ireland and a tiny, tiny bit in the rest of Europe. So yeah, I would just be staying well clear for those reasons. Sam, what are your thoughts?
Pretty similar. I also think as well, I don't even think it's that cheap at a forward P of 13 for a business that's not really growing with all those kind of negatives. And the yield's not that great. So yeah, I don't know why on any level you'd want it in the portfolio.
No. Okay.
It's really hard to make any kind of arguments.
Okay. Well, that's fine. Let's move on quickly then. Hollywood Bowl.
Yes, so Hollywood Bowl, we have covered them quite a bit recently, actually. So I think most people will be familiar with them, but they are the UK and Canada's largest 10-pin bowling operator, and they have come out with their half-year results. And revenue was up 9.5%. Group adjusted EBITDA after rent was up 8.9%. That's an odd metric. I don't think we've ever seen that one before. Group adjusted EBITDA after rent. As if you've not stripped enough out. Okay, so anyway, adjusted earnings per share was up 11.3%. Dividend was up 10.2%. Net cash was up 14.3%, and the earnings were down 2.5%. So in the UK, spend per game was up 7.6% with growth in all categories. So UK like-for-like revenue growth was up 2.6%, and Canada like-for-like revenue growth was up 0.5%, with impacts from snowstorms affecting that, which I find a bit odd, actually. I don't know much about what the snowstorm season was like in Canada this year, but one of the things we talked about previously was that Canada's actually quite a good market for bowling because there's so much snow. People are doing more indoor activities. So there must have been a lot of snow if they can't even go bowling. For the Canadian expansion, which is their growth market, they are the largest branded operator in Canada with 16 centres. They've got a new CEO in Canada. New prime location in Edmonton opened in the period and is trading well. The refurbishment program across Legacy Estate is almost complete, and they're targeting 35 centres in Canada by 2032, which is an acceleration of the previous 2035 target. And in terms of the valuation, the business trades at a P of 13.6 and has a yield of 4.64%. I thought these results were pretty good. I think that like for like is a bit disappointing. I'll just take the snowstorm excuse at face value in Canada, but I think, in fairness to them, the growth has been coming from new openings in Canada and acquisitions anyway. So we're not, I guess any like for like growth is just a bonus, really. But yeah, in terms of the targets, they seem to be moving towards them. I think that Canadian expansion, moving the target from 2035 to 32 is very positive. But yeah, I think it's a decent set of results and a decent company. I think the valuation's pretty reasonable for the growth, and I think the yield's pretty good as well. So yeah, I think you could do a lot worse. What about you, John?
I would agree with those points. I think the concerns I would have if I were to put the sort of bear case across would be that it is a pure play on bowling, which you can see as a positive and as a negative. I'd probably feel more relaxed if it did have something else in the portfolio in terms of, I think we've talked about crazy golf, something else just to fall back on if there were any changes in the trends towards bowling. I think that would be my main concern. Also, consumer discretionary spending, if that does come under pressure, I would imagine this can be quite a cyclical industry. So they would be the two concerns. And I think at the moment, particularly in the UK, when you're looking at the UK stock market, there are quite a few businesses that are more attractive at very reasonable valuations. So that would be probably, I guess, some of the reasons I wouldn't, and then that sort of opportunity cost just at the end there.
Again, we did cover it more last time, but in terms of the sort of businesses that you would think would complement them, there's actually been quite a revival, it feels like, in some of those kind of industries. I don't know what you'd call them. I want to say adult entertainment, but that sounds a bit cheesy. But that kind of almost adult bar-y, gamey place. You've got like Junkyard Golf, you've got Flight Club, Boom Battle Bar is another one, but there's quite a few businesses like that now that seem to be growing quite well. So yeah, if they could acquire one of them, I think it would work really well. But that being said, the focus is on Canada, and I think that is working in fairness.
Yeah. And I don't know what the Canadian economy is like, but you would hope it's better than the UK.
Well, yeah, it's not saying much though, is it? But we don't know about these snowstorms though.
Well, that's right. That's right. I haven't heard that one before, but equally, we're not covering Canada in any other meaningful way. So,
should we move on to pets at home then?
Yeah, no, absolutely. So we haven't covered Pets at Home for a little while now, but they had their full year results out last week, with group revenue rising by 1% to £1.98 billion, but statutory revenue slipping by 0.8% to £1.47 billion. Profit was weaker. Underlying profit before tax fell 30% to £92.8 million, while statutory profit before tax fell 28.3% to £86.5 million. And underlying EPS also fell by 29.7% to 14.8 pence. The retail division remained the problem area, with retail consumer revenue down by 1% to £1.29 billion, but underlying profit before tax dropping much more sharply, down 57.8% to £30.8 million, as lower sales and gross margin pressure hit operating leverage. Management said that retail turnaround plan is starting to help, with better momentum in the second half and positive sales volume trends. The vet group was the brightest spot, with vet consumer revenue rising 5% to £688.1 million, and vet underlying profit before tax rising 10.4% to £83.8 million. Management pointed to the care plan growth, higher average transaction values, and operating leverage of its joint venture vet model, with subscriptions increasing by 15.2%, consumer revenue up from 13%, with more than half of vet clients on a care plan. Margins were under pressure, with group gross margin falling by 120 basis points to 45.7%, and retail gross margin was down 180 basis points, including planned price investment, whilst vet margin improved due to the greater contribution from the JV fee income. Operating costs rose 1.9%, though management said cost control was helped by productivity actions and completed a £20 million overhead savings programme. Cash generation was also down, with free cash flow falling by 26.1% to £61.9 million, mainly down to retail free cash flow dropping from 30 to 2.7 million. Balance sheet net debt was £19.4 million, and that's only around 0.1 times underlying EBITDA. And Pets at Home, as a result, cut the dividend by 43% to 7.4 pence, rebasing it to 50% of EPS payout ratio, but announced a further £50 million share buyback to be completed in the next 12 months, which seems strange. For the full year 27, management have said it was comfortable with the analyst consensus for underlying profit before tax of around £98 to £99 million, suggesting a modest profit recovery rather than a rapid return to prior year levels. In terms of valuation, the group have a market cap of £755 million and trade at 13.3 times forward earnings, compared with a 10-year average of 15.5%, and they have a prospective dividend yield of 5.1%, compared with a 10-year average of 3.8%. I think the results are disappointing. It is a very difficult environment, and I think, as we touched on before, tightened consumer spending, increased costs in the retail business, making it even more difficult, and they did have a very strong COVID too. I think it's encouraging that the vet group is still performing well, but it's a tough environment. And with increasing direct-to-consumer, I think that is putting pressure on the retail business too. I certainly don't think it's expensive. And if they could almost do the equivalent of what Tesco had done operationally in their retail division, which is a big ask. And they also have that VIP, a bit like the Tesco Club Cards scheme, the sort of VIP pets. And they do have the sort of the synergy, or what could be the synergy, with the vets business. Then you could make the bull case for it. But I think it is very, very hard. Sam, what are your thoughts?
I think these results are pretty concerning, actually. I've always considered Pets at Home as one of the better UK retailers that we cover on the show. And this is kind of the first set of results that's had any, not every set of results they've done has been perfect by any means, but this is the first set where it just feels a bit like they're kind of running out of steam. Those margins coming under pressure, it's not like it's come under pressure by choice because they're investing in this or whatever. I know they've said it's because of like they're trying to grow the revenue and stuff, but it just feels like a bit of an excuse. It seems almost like you say, they're maybe where Tesco were 10 years ago when they were getting that pressure from Aldi and whoever else. And I find it quite difficult to see where they go from here, really, because I My concern would be that if it continues, those margins could get quite a bit worse. So I'd probably just be inclined to steer clear of it, actually, because it looks, I know it's one set of results, but my concern would be what's in there. It could be the start of a trend.
Yeah, and I suppose the other thing is the more positive part of the business with the veterinary model. That now is, there's been a lot of consolidation there, and there's always talk about the CMA getting involved in that. And if they got more involved in that, the growth part of the business, or what has been in this set of results, the growth part of the business could also be hit quite badly. So I think there are lots and lots of issues.
Yes, I think not that I would probably ever invest in it anyway, because although I think it's a good retailer, there are better retailers that you can get. But if someone was thinking of it, I'd probably give it 6 to 12 months and I'd want to be sure that this is a one-off and not the start of a trend. And if you end up buying it at a higher price, so be it, because I think that risk is quite high.
Yeah. Fine. Okay. So going on to a business that you used to own.
Yes, PayPal, one I sold. I didn't do very well on it, but it's nice to know that had I not sold it, I would have done even worse. But for context, I bought PayPal, I think around $60, $70 a share. It's now at 42. I think it was about 46 when I sold it. So I didn't do particularly well on it myself, but every little helps. So PayPal, they've come out with Q1 results and revenue grew by 5%, which was lower than payment volume growth, which was up 8%. And that was due to pricing actions and a shift in the product mix. Underlying operating profit fell 5%, and that was largely due to increased transaction expenses. Underlying free cash flow grew 25%, and that was helped by the timing of receipts and payments. Net debt came in at 100 million compared to 400 million of net cash at the year end, but compared to the size of the business, it doesn't really matter at that level. And they declared a dividend of 14 cents per share and repurchased 1.5 billion of stock in the quarter. And for context, that's on a market cap of 37.5 billion. So that at that rate, they would be repurchasing 6 billion a year. So you're basically getting on for like nearly a sixth of the market cap being bought back a year, which is a lot. Guidance for underlying earnings per share still ranges from slightly positive to low single-digit decline. In the second quarter, however, the decline is expected to reach about 9%, about 5 percentage points worse than forecast, and the shares fell 8% following the announcement. They are on a new CEO, and he has moved quickly to simplify and streamline. And it seems like he is going down the Unilever route of turning around the business. So there is a potential breakup on the table regarding a disposal of the consumer financial service arm, which is his fastest growing division, which is Venmo and buy now, pay later. So that might be spun out. And they're looking at stripping out 1.5 billion of costs. But yeah, that's basically the plan, I think, kind of cut costs and spin out Venmo. In fairness, the Venmo numbers have always been very good whenever they've given those. So I do think Venmo probably would trade at a higher valuation than PayPal. So it possibly would unlock some value, but it's not really solving the core issue of the business. In terms of valuation, the business trades at a forward P of 9.2. 10-year average is 26. Prospective yield is 1.1%. And the 10-year average is nil. And obviously you've got those buybacks as well that we mentioned, which are very chunky. I think these results are pretty poor. I think the operating profit falling, that trend has continued, and that is very concerning. Yeah, I find it really difficult. I think I'm probably a bit biased because I held it for a few years thinking that the results would get better, and they've just continued to get worse. So I think I'm glad that I'm out of it. I won't be buying back in, I don't think. But I think, in fairness, if they were to spin out Venmo, I could see that actually unlocking some value. What about you, John, who's someone who's a bit less biased?
Yeah, I think about my own life, and I used to use PayPal a fair bit, and then Apple Pay came along, and I don't know what percentage of my transactions go through that, but a high number. And do I miss PayPal at all? Not really. It was always a little bit clunky. If I'm paying on my credit card anyway, I get a level of protection. So I can see why the business, there is that sort of structural decline element to it. And then obviously for Android users, they can use sort of Google Pay. So yeah, I do struggle. I appreciate on paper it does look cheap. and they are buying back shares at a phenomenal rate, but that's not an investment case as far as I'm concerned.
So then, of the 6 businesses this week, British American Tobacco, B&M, SSE, Hollywood Bowl, Pets at Home and PayPal, which do you like the most and which do you like the least?
It's not a great selection this week. I would, despite what I said about the concentration of the pure play on bowling, I'd probably go for Hollywood Bowl as my first choice. And last, I think SSE. I think that's, as an industry, is completely uninvestable.
So I think I would also go with Hollywood Bowl first. I think for last, it's probably one of the most competitive weeks we've had in a while at the bottom. But I think I would go B&M. And I just think, as much as I dislike SSE, I think for me, the accounting scandal is just absolutely unforgivable, because at least with SSE, you might not like the numbers, but you can trust them.
Fair point. Okay, well, on that, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW_tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.